Good morning, everybody, and welcome to the FSC ReGenerations conference, the second session on the future of the financial advice sector. My name is Mark Benicevic. I'm Head of Industry Engagement at Partners Life, and it's my absolute pleasure to be facilitating this session with a panel of absolute legends. I thought about how I was going to introduce these amazing people and in which order I would do so, and decided that the only way I could do so was alphabetically, although it may just seem discourteous, and for that I apologise. So it's going to have to be in alphabetical order. I will start with Ben Brinkerhoff. Ben is Head of Advisor Services at Consilium. He's been there since its inception in 2012, and Consilium has $6.5 billion of funds under advice. He works with over 120 financial advice firms across Australia and New Zealand, and has an extensive background in North America as well, being from the US in particular, where he's from. So we'll get some good insights from Ben. So welcome, Ben. We have David Greenslade. David Greenslade is the founder and executive director of Strategy Group, which he started in 1999. It's a leading education provider for financial advisors, I'm sure everybody knows. He has, of course, a number of memberships and things. He's a financial advisor. He's got auditing qualifications, governance qualifications, leadership memberships. So he's an amazing man to have on our panel. So welcome, David. Our third panelist is Hannah McQueen. She's the founder of Enable Me. I'm sure many of you are familiar with her. If not from Enable Me, then as an author of her many books. She helps people repay mortgages faster and prepare for their retirement, and is passionate about helping people get themselves financially sorted. Amazing practice for doing so. She's also an accountant, has a master's in tax, and is a financial advisor, of course. So welcome, Hannah. And the last person on our panel is Katrina Shanks, who is the CEO of Financial Advice New Zealand. She's been in that role for 3 years. She's a former Minister of Parliament, so she knows the legislation process very well, which has been very essential for her role in the last 3 years, given all of the legislative changes happening in our industry. She's extensive experience leading membership organisations as well, and has been an absolute stalwart of our industry of the last few years. So welcome, Katrina. Now, before I lead on with questions to our panelists, I just want to go through a few slides that I've prepared that show a bit of the shape of the financial services industry over the last kind of 11 years since the Financial Advisors Act was first in 2000, or first came into force in 2010. This first chart shows financial advisors from 2010 through to 2020-21. And we've got the number of advisors who registered each quarter during that 11-year period. The purple part of the column shows the financial advisors who remain on the register, or in particular remained on the register at the 1st of March 2021. And the green part of the column represents those who are no longer on the register. So what this shows, as you'd expect, there's a large spike of financial advisors who registered at the inception of the Financial Advisors Act, and then a regular trickle of financial advisors registering each quarter from there on. But what it also shows that's very interesting is that there's a larger portion of financial advisors who registered in 2010 that remained on the register than there have been in every quarter since. And in fact, it was 8 years before the line crosses. So that line shows the percentage that remain registered. So the people that were already financial advisors when the Financial Advisors Act came into force, and had probably been financial advisors for many years beforehand, they tended to stick around. But there's been a large turnover of new people entering the industry ever since. If we move on to the next slide, we'll see the same columns, but the line this time shows the tenure of those financial advisors. So those financial advisors, now remember, this is tenure since the inception of the FSPR in 2010. So those people who registered in those first few quarters may have been financial advisors for 20 years before that. So those people since 2010 had a tenure before they deregistered. So we're only looking at the people in the green now of between 4 and 6 years on average. Whereas those people who joined the register after that first spike tended to have an average tenure of about 2 years, even though we're talking about close to a 10-year period. So the people who joined post the initial rush in 2010, 2011 tended to be quite transitional. And some of them have stayed, but many of them have tried and gone. Now, moving to the next slide, this shows the quarter of deregistrations. So the green data are the Financial Advisors Act data from an extract in March 2021. And the purple data are from the extract in October 2021. So it's showing the latest stuff on top of this. So this is the quarter in which advisors deregistered. You can see that there was the initial burst, of course, 2010, 2011 of people registering, and then there was a little burst of people deregistering in early 2012. From then on, it's fairly stable right the way through until the third quarter of 2021. So there was a lot of expectation that the Financial Services Legislation Amendment Act would lead to a mass exodus from the industry. What we're seeing, and it's only recently in that third quarter of 2021 where we're seeing a spike of deregistrations. Now, that spike of deregistrations is probably largely led from that period where, as we know, the ministry went out and said any financial advisor who wasn't engaged by a financial advice provider by the 15th of June, they'd commence deregistration proceedings. So there's a large spike there that probably represents those. But through the period in between, it's a fairly balanced level of people that are deregistering each quarter. So that's a brief picture of the Financial Advisors Act story. Now, for the first time, if we move on to the next slide, we're going to start to see how the entities have been structured. Now, the Financial Advisors Act, of course, very much individualized financial advice. The regulation was very much on an individual basis. There were 9,670 financial advisors on the FSPR as at the 1st of March 2021, and about 2,000 of those were AFAs. AFAs had their annual return that they had to present. They had their CPD requirements, but they were all very individual requirements. And registered financial advisors had less onerous obligations. Now the obligations are moving towards an entity basis. So we're finally starting to see the picture of how the entities come together. In this chart, the purple column is financial advice providers. So that's the sum of financial advice providers and authorized bodies. And there's about 3,000 of those. Okay, so we can see in this chart, the purple columns represent financial advice providers and authorized bodies by the number of financial advisors they directly engage. Very interestingly, you see 567 financial advice providers who don't engage any financial advisors. Now, about half of those, there are 244 sole trader financial advice providers as at the date of this, the 1st of October. So the individual is a financial advice provider, so they're giving advice, they don't have a financial advisor engaged. But that leaves about 300 financial advice providers that don't have anybody giving advice. Then there's about 1,500 or 1,600 with one financial advisor. And then right down the other end, you can see there are two entities that have over 500 advisors each directly engaged. Now, in a moment, I'll show you a slide where I've moved the financial advisors that are engaged by authorized bodies into their FAPs, and we'll see how that picture changes. But you can see there's quite an even spread there across different sized entities. Now, if we move to the next slide, of the 3,000 odd financial advice providers, around 2,000 of them are license holders and about 1,300 of them are authorized bodies. Now, those authorized bodies are engaged by 126 financial advice providers. So there are 1,600 financial advice providers that don't have any authorized bodies and 126 who do. Now, of those 126 authorized bodies, which are shown in purple, you can see 61 of them have one authorized body. So 61 FAPs have one authorized body. Then down the other end, you can see there's one financial advice provider that has about 450 authorized bodies. So that kind of shows the spread of authorized bodies are very much down the far end, where you have a small number of entities with a large number of authorized bodies. These quite complex structures, and a small number of entities that have one or two authorized bodies. And if we move on to the final slide, this is where I've taken only financial advice providers who hold a license and looked at the financial advisors who are engaged by those financial advice providers, whether directly or indirectly through their authorized bodies. And you can see that the financial advice providers have really flattened down quite a lot. there's only 407 financial advice providers now who don't have any financial advisors. Now, that's very interesting, considering there's only 244 sole trader financial advice providers. The other 160, who's giving advice? I'm not quite sure about how that's laying out. That 1,600 number of entities with one financial advisor is now reduced down to 700. So the other 800 financial advice providers with one financial advisor are engaged as authorized bodies through a different license holder. There are 700 of them that are managing their own license, doing it without any direct relationships with another financial advice provider. And then down the far end, you can see that instead of 2 financial advice providers with more than 500 financial advisors, there are now 3. So one of them is engaging them through those 455 authorized bodies. And so you can now see that there are more financial advisors engaged down the bigger end. If we look at the total number of financial advisors, a lot of them are being engaged through these larger entities, whether directly or indirectly. But there are still a significant number of people down the far end. Now, interestingly, looking at the data from Australia with a report that David White sent me a few months ago, I'd always thought that in Australia, that was very much dominated by the large end of town and everyone had big licenses and there weren't a lot of small players. But it seems that the layout in Australia is quite similar, where you have small entities and a few large entities, but the large entities, of course, engage the largest volume of financial advisors. There's quite an even spread, very much like what we see here. So that's the end of my slides, and time to get insights from the panel about what's going to happen next, which is really the purpose of this discussion. So we'll start with a question for Katrina, because we want to kind of get a feel for what's going on overseas and where this kind of licensing approach has taken us. And Katrina, of course, given your role as CEO of Financial Advice New Zealand, you've got your sister organisations in Australia. How did the industry kind of change when regulation was introduced there?
Yes, it's been a really interesting journey for them. So I think from the Royal Commission, they came out quite battered and bruised and feeling like they'd been under the lights and they hadn't come out particularly well. And so I think they started from that basis of it's fairly tough going. And they were pretty much held to account, as were the financial institutions. So I think they started from that point, and then obviously the regulation came in over the top of that and the new legislation in terms of different requirements for them. So what they've had to do to continue operating, many of the financial advisors, is they have to sit an exam, they have to get a graduate diploma, and they have to do 40 hours CPD. What they're seeing is they're losing advisors, their experienced advisors. So they've got an average age in Australia of 54 for financial advisors. And what they're seeing is a lot of those advisors not wanting to stay in the sector and have to do further education to give financial advice. So they're seeing an exit from them. But also they're not seeing it coming from up through the bottom either, because they've got some reputational damage. It's not seen as a go-to profession because they have been damaged for the last 2 or 3 years. And so they've got a gap. There's going to be a massive knowledge gap between the massive exodus at one end and no new entrants coming out through the bottom. And I think the other thing that you're seeing over there is the cost of providing financial advice is significant, and their licensing costs are also quite significant now. So there's a lot of pressure on the businesses. So not only do they have to retain staff, they have to train staff, and they've got another layer of costs on them which they didn't have before. So it's quite a precious situation over there, and I think it's going to take them a while to recover. So what we're seeing, New Zealand is quite different to that. We're a totally different environment. Yeah, we're a totally different environment in New Zealand. We're quite a vibrant profession. I think the legislation and the regulation and the licensing will lift standards in New Zealand. I think everybody understands what that looks like. We're talking about level 5 qualifications or the outcomes of level 5 to provide financial advice in New Zealand, which is quite different. We haven't seen huge licensing costs come onto our advisor firms at the moment, and I think everybody is just getting on and doing what they need to do, because I think what we've got in New Zealand is a vibrant profession, and I think that'll hold us in good stead going forward.
Yeah, thanks for you're right. We're very lucky that we've had the ability to learn from what Australia has done and not copy them. And I think it's a really good thing. We've got to keep an eye on what's going on there and be careful. The age demographics are a really interesting one, and one that we don't have access to the data to. when I was at the Financial Markets Authority, I remember doing an analysis because we had the full FSPR, so I was able to do that. And the population of financial advisors wasn't as old as a lot of people made out. It was actually quite bimodal. There's a swell of young people coming through, as well as this aging group that's going through. So it would be very interesting to see what those data look like now.
Yeah, and I think you picked up an interesting point in your presentation to begin with, in that what we need to do is ensure that we have career pathways in this industry, and people don't leave after 2 years because they can't make a living out of it. So we need to understand what that future looks like, which I think is quite exciting for us as well. We've got opportunities to improve and change.
Yeah, great. Thanks, Katrina. Ben, you're from North America, from the US, and that's a very mature market there in terms of financial advice and financial services. Can you reflect on your experience from the US, and is there anything we can learn from there?
Thanks, Mark. So in North America, at least as of the time I left, which was about 10 years ago, there's the acts in which we're regulating financial advice were passed in 1933, 1934, and 1940, right? So those were the main acts. And the differences between the two were like the 33 and 34 Act really regulated brokers and said about a suitability rule that you had to provide suitable advice. I mean, that came to the forefront in the GFC when the CEO of Goldman Sachs got up and said, oh, it was okay we passed these CDOs to our clients. It was suitable, right? And the 1940 Act is what we would consider to be the independent financial advisory space was created. And those firms are called Registered Investment Advisors, or RIAs. And what has really happened over the last 20 years that's been fascinating to me is that the space was for a long time dominated by groups we called wirehouses. And you would know some of them. UBS would be a wirehouse, Morgan Stanley would be a wirehouse. And the methodology that they would use is they had the best access to data. And if you wanted to invest, you would go to them and you'd be able to trade and get that full brokerage service. And the independent space was kind of small and not even very well thought of. But with the proliferation of data that smaller firms could access, and with the increase in fintech allowing smaller firms to access scale at a much smaller starting space, we now see that over the last 20 years, the independent advisors, the RAs, now have more market share than the large wirehouses. And I don't know if you can understand what a significant development that is. And then the reality is, I mean, this is a little bit my bias is coming through perhaps, but the 1940 Act required of financial advisors a fiduciary rule. You had to act in the interest of your clients. And as a result of that, coupled itself very naturally with the CFP regulations and the proliferation of good quality training about how to be a good advice, acting in the interests of your client solely. And also the complexity in America, where you have money so many different places that your needs are a lot more diverse than simply having a good portfolio. You actually have to be smart about the way you allocate and look at your money holistically. And it's just led to a boom of in the independent space. And so I think that is maybe a reality of having, a very well documented and clear regulatory environments, not changing a lot like it has been in New Zealand. But I also just think it's the result of technology being used by smaller firms to be more innovative and entrepreneurial. And so the United States has really seen that. So in some respects, maybe just the opposite, in that it's kind of gotten more independent and maybe smaller than what we're seeing recently in New Zealand.
Yeah, absolutely. Yeah, those innovations are going to be very, very interesting to see playing over to New Zealand, and I'd love to get into that technology discussion a little bit later on. Cool, thanks, Ben. That's a really interesting shift. David, when the Financial Advisors Act was replaced through this process of financial services legislation, the Amendment Act, there are a lot of people thinking that this would be, there'd be a huge exodus from the industry. And I've just showed the data that show that it kind of hasn't really happened yet. We've gone from 9,670 financial advisors to about 9,256 financial advisors that we had on the 1st of October. Although there were 1,256 odd advisors that have left the industry, there's another 1,000 that have joined the industry. So the numbers haven't dropped too much, although we do still have full licensing to come, and really the biggest burden is still to come. So we're hearing anecdotally of advisors leaving, but the data don't really support that yet. Do you think there'll be a bigger exodus than we've seen so far? And if so, what kind of financial advisors will be the ones that do leave, and what kind will stay?
Yeah, so the quick answer is we don't foresee any tsunami of advisor exits. But let me just talk you through the rationale behind that. So the first thing is, at the moment, our industry average age is relatively old, so there's always going to be a natural level of retirement. But what's actually been happening over recent years is that many advisors have been delaying their retirement simply because the markets and the environment in which they work has been so fantastically good to them. This has been some of the best times I've seen in my 30-year advisor career to make money as a financial advisor. It's been mecca, really, for many of them. And so what they've done, in the absence of strong regulatory imperatives, because they're in this 2-year transition period, they've gone, well, I'll hedge my bets. I'll hang around in the industry. I'll make money while I can. I'll look after my clients, and I'll delay making my decision until closer to the time and see how everything sort of shakes down. So what we're seeing is a lot of people having actually delayed their natural retirement. Now, that will eventually catch up. And as we get closer to the last 6 months, particularly of before the end of the transition period, you will see a surge in the advisor exits. But that is really a delayed retirement. Plus, there will be a small number of people who will exit and blame it on the new regulatory environment. But personally, I think that's probably only going to be around about sort of 10%. Now, there's some other factors that are impacting on this. And I look at it right at the moment and go, the impact of COVID-19 possibly is having a bigger impact on what's going to force advisors to rethink whether they stay in this industry or change their business model, because about 60% or so of our industry is located from Taupo north. And these people, some of them, particularly those that haven't got well-established recurring revenue streams, they're starting to do it pretty damn tough, and they're just worn out. So it's a time for them to rethink what they're going to do. Now, there's also a whole lot of misinformation and a whole lot of unfounded fear in the industry. And people have been sort of banging on saying, come and join our organisation because the cost of compliance, the cost of training and everything is prohibitive. And if you come and work under us, we'll take away all of those problems. But that's not really the case, because if you go in as an authorised body underneath a FAP, or you have your own FAP licence, someone's going to pay the costs somewhere along the line. So the costs end up being pretty much the same, regardless of your structure. So my view is that our industry and our advisors are quite astute. They're very adaptable. As they get more and more into this regime, they will realise, hopefully, that this is more flexible operating environment than what they were led to believe. The cost of doing business is pretty minimal, because in real terms, for a single advisor business to meet all its compliance obligations is probably going to cost them under $5,000 a year. So if you've got a viable business to start with, then $5,000 for your compliance is next to nothing. But if your business is subscale and not viable already, well, then 5,000 is obviously going to be a significant contributing factor to why you would want to sort of retire. So then we look at what Katrina was talking about with Australia, and people are trying to look at Australia and go, well, the regulatory change there forced a whole lot of people to exit. But as Katrina so rightly said, this is not Australia. We are a principles-based regime with a far more enlightened regulator than what we see in Australia. So the cost of doing business is a lot lower from this sort of perspective. The other innovation we've got here is we've got the 3 classes of our license. So it enables advisor businesses to operate as a single shingle just as effectively as if you had 2 or 3 or 5 advisors or you're at the bigger end of town. You don't have the same compliance costs over all of that. The other thing that then happens is advisors, as they work their way through, many will embrace technology. And once they think through technology, they think through and realise that this new regime is encouraging innovation. It's encouraging you to drive down compliance costs. What you will do is you'll embrace the technology in a careful, considered way into your advice process. You will fundamentally rejig the way you do advice. You will rejig your advice documents, and you may tweak your service proposition at the same time. If you do all of that, then you can actually better leverage your own skill set along the way. And on top of all of this, we've got a couple of factors that are impacting on it. The first one is, if our businesses are purely focused on selling product, then eventually technology will surpass you in that regime. But if you focus on actually giving advice and you focus on the complexity around advice and you deal with answering the complex questions that clients have, as opposed to the simplistic thing about selling product, then you will have a very viable business into the future that is not going to be sort of held to ransom by new technology platforms coming in that are selling product. So I'm in the same camp as Katrina, and I believe we have a viable business moving forward. So those that are going to exit will be the older ones who were going to exit anyway, but have just been delaying it. And there will be a small number of people who don't have scale in their business and are basically over trying to sort of work outrageous hours, and they'll either exit the industry and then they'll have a wake-up call, because wherever else they go, their education, qualification, entry standards are going to be higher, or they're going to go and join another organisation as an employee or a contractor. But I see nothing but good out there, because there's a huge number of smart young university graduates flooding into the industry at the moment and going through doing their level 5. You just don't see or hear about that in the mainstream media, but they are there. So I think it's all good, Mark.
Yeah, great. Thank you, David. That's a really good time to segue into Hannah. I'm sorry, Hannah, that I'm going to give you a nasty question first, because it's one that financial advisors are very concerned about. But you've got a very interesting model in this space, and this is about commission. Commissions received significant since the Australian Royal Commission in 2018, and the Conduct of Financial Institutions Bill that's presently before Parliament is probably going to have some impact on this as well. So consumers and most commonly directly pay for their financial advice. Many financial advisors are not fee-based, they're taking commission from providers instead. And I know your structure is a little bit different, which is why it's really good to ask you this question. Do you think the way that consumers pay for financial advice will change over the next few years? And if so, how? Why?
Yes, I do. I think that the regulation is going to force the banks, for example, to stick to their lanes and be more overt in disclosing their conflicts of interest for any casual advice that they give. I read a study a few years ago that said the majority of Kiwis actually get their advice from their bank, which is a bit of a concern, because if you're getting advice on your mortgage from your bank, I mean, they stand to make a whole lot of money the longer you take to pay that mortgage off. And I certainly think there's an education gap for a lot of Kiwis who have previously been able to take a DIY approach to their finances, because that's what our grandparents did, right? They didn't really need to be particularly good with money. They just needed to not be bad and to spend less than they earn and be okay delaying their gratification and get on the property ladder, but it was so much easier to do so. And then they could just coast on through and retirement was going to be okay. Whereas now the conditions that we've got to try and be financially successful in is a lot harder for this generation than what it was for previous generations. So I think that is going to require an acknowledgement that most people will need a financial strategy that is fit for purpose for them, and they require a considered approach. And that approach probably needs to address changing their behaviours and changing their mindset and creating a strategy that engages them as opposed to just talking about financial literacy and products. So back to your question, I think that for those people who can provide a clear financial strategy or something that a consumer can see the value in because they themselves don't have that skill set, there is room to quantify that value and charge a fee. And when you charge a fee, well, it's a different game, but you have to be able to deliver on that fee. So Enable Me, and as you said earlier, I come from a law and accounting background, so I'm very familiar with charging for my time. That's how I've been indoctrinated. And when I first moved into the financial services area, I was surprised and a little bit confused with how murky and hazy some of the commission structures were and the lack of disclosures, because we disclose up the wahoo in the accounting industry. So I think all this regulation that we're going through, I think it's fantastic for everyone, and those who want to provide good quality advice. There is going to be huge, almost endless opportunity to do that. But when you start to charge for your service, you need to be able to quantify the value you are delivering over and above the market, and you need to be able to deliver on that. And that is something that not all financial advisors are used to doing, but I think that's where we're going to be going. Or at the very least, for those who are already there is a huge opportunity, because with charging for advice, you can also be agnostic in your advice. And not many financial advisors can stand behind that. But when you think about the risks that are, the financial risks that are applying to this generation, this lack of financial well-being that people are facing because they're not on track for retirement, that risk is permeating and now impacting relationships, like their personal relationships. It's impacting their insomnia, their overall well-being, their productivity at work. So this financial stress is permeating through the world, actually, the developed world. So when you think of employers that previously might not have wanted to go there when it comes to their employees' financial well-being, possibly because they think that they'll just have to give them a pay rise. No one can afford to do that. But now, because the lack of their employees not being financially stressed is now linking through to a drop in productivity at work. And I think Deloitte's quantified that as $7,000 US per year of a financially stressed employee, and then went on to say that 80% of the workforce was financially stressed. And this was before COVID. So suddenly the impact of not having a financial plan and making financial progress is impacting people who previously didn't even want to know about it. And when they now have a vested interest in getting their staff financially strong for possibly different motivations, they want agnostic advice for their staff. They don't want to align with one particular product. They want to know that their staff are getting the right advice for their life stage, their opportunities and their obstacles. And when I look at what's coming to this industry, I think it's a huge opportunity for those who do want to be agnostic. That requires you to be agnostic, though. And so you must first design your strategy, and then you go through the products that could work with that strategy, as opposed to, at the moment, it feels like many advisors start with the product that they're selling and try and work out, how do I shoehorn this to the customer? And that's, I think the days of that happening are going to slowly end, and I think that's going to be a good thing for the consumers.
Yeah, I agree. I think that may ultimately lead to as well a difference in the way that the advisors themselves are remunerated. So we have an opportunity now moving to an entity-based approach. If you have, as you say, if you've got an agnostic advisor, they've got the opportunity to give very unbiased advice. And if you pay those advisors then by a traditional salary plus bonus type model, and the bonus being based on their performance of giving service rather than the revenue that they generate or the amount of sales they generate, then you're in a position where you can achieve that. So I wonder whether there's an opportunity now to move, particularly in these kind of middle-sized firms, to a model where the employers are brought on a more traditional salary type model rather than being on a commission-only model, moving away from sales and into service.
Well, I think if you're going to be agnostic, you have to be paid a salary, right? That's the bottom line. Otherwise, your words don't match up to what's happening behind the doors.
Yeah, absolutely. Yeah, thank you. Katrina, I just want to come back to the question about the number of advisors in the industry. And I'll start with asking you this question around how many advisors will enter the industry. You talked before about in the Australian market where advisors are so battered and bruised, no one new is coming in the door. We have a model in New Zealand where traditionally advisors would either come out of a bank or they might come in as what we call a sub-agent or an existing advisor, and then once they come off their training wheels, they go and form their own business. Whereas that's kind of going to change now with this need for a license. So where are new advisors going to come from, and how do you see that working in the new world?
Well, in the short term, it's difficult for small firms to get new advisors in under a transitional license. So, and what we're seeing out there is it's a very competitive market for advisors moving from, an authorised body or a company to, not necessarily the fat company to company, as they're trying to keep advisors in the door. So, as you know, it's a transitional sector. You said a stat about, an average advisor stays in for 2 years and goes. We've got a 2-year transitional period. If you are a small company, it's very hard to get a new advisor in to give advice unless they're already giving advice pre the transitional period or they're qualified to give that advice. They've got that level 5 qualification. So for a small organisation that doesn't have the systems controls of outcomes of level 5, they're very limited as who they can get in to give advice, and they've got to be very careful. If they do get someone in and they don't have those processes and controls of level 5, and the person hasn't given advice before, and they don't have a qualification, but you're getting them to help you, they've got to be really careful what you get them to help you with in your business, and they're not accidentally slipping into giving advice. When full licensing comes in, that changes a little bit more, and it becomes a little bit clearer as to who and how you can get advisors into your business. But I think over the short term for a smaller business, it's difficult to get staff to give advice if you've got a turnover of staff. So the key thing is what can you do to keep and maintain the staff that you've got now, and those financial advisors which are giving really good advice, and look after them. And if you are looking for advisors, those feeds which you've had been coming through, the banks and the insurance companies, what type of advice were they giving, and can they give advice in your business under your transitional license going forward?
Yeah, that's strong points. And I think we're also going to need a bit of a mindset shift as well, because we've come from a period where existing financial advisors financial advice was often a second career, and the advisors were able to recruit from essentially anywhere, people that they met that had the right kind of aptitude but had never been in financial advice before. Whereas now they can't give financial advice until they've got a level 5 certificate. So they've got to have some investments and skin in the game. And they were used to bringing people on at almost very little cost because they weren't paying a salary. Give it a go and see how much commission you can earn.
Yeah.
Whereas now they've got to actually invest that 6 to 9 months in getting the qualification before they can go out the door. So that's going to be a bit of a hurdle to getting new people as well.
But I think at the same time it's exciting, because what it's doing is it's shaking up the way people are looking at getting financial advisors in their business. And for the first time ever, we're most probably starting businesses to think about career pathways. I need to invest in this person. I want them to get a qualification. I want them to be able to give advice. And all of a sudden, this is what a profession is. It's having a qualification, having competency, knowledge and skill for everybody that's giving advice. Previously, we had an AFA, RFA world. Now we've got a financial advice world and financial advisor world. And I think that's the excitement going forward. And the opportunity. I think it's fantastic. I think it'll be long term. It'll be great for the industry.
The other thing I think that kind of extends from that, and we'll go on to the next question as well, is in the past when somebody came into this industry and wanted to start a business, they'd have a little bit of experience, a couple of years giving financial advice, and then go, I'm going to go and do it myself now and take all of the commission rather than paying a cut further up the chain. Whereas now, to go into business, you have to have a license. So I think we're going to shift a little bit more to financial advice being a vocation or a profession that's separate from running a business. Whereas now they're kind of intertwined, and there's going to have to be the separation. The business runner is going to need to have a license to do so. That also means when you start up a business, you're going to need capital. We're in an industry where you could step in and start being a financial advisor at very little to no cost and just try and get that first piece of advice across the line, get a bit of commission in the door, and then try and work for the next one. Whereas now we're going to move to a more, any other business, if you start up a business, you've got to find a couple of $100,000 worth of capital, borrow some money, or put some savings aside, and expect to make no money for the first 6 to 12 to 18 months until you break even, right? And I think financial advice is going to move more into that traditional model of getting capital to start a business, putting your structure and stuff in place, finding the right people for the roles, and moving to a break-even position in sort of 12 to 18 months. So I think
you just raised a really good point, Mark. And I've just got my level 5 qualification a few months ago, and I would hate to go out and give advice without being under the umbrella of someone who could watch me, mentor me, and help me give advice, because I think there's a lot more to advice than just getting the qualification. I think there's a lot of competency, knowledge, and skill you have to have before you put out your shingle. And from what I've had of my experience, it's been absolutely insightful for me, being able to deliver a professional development and all that type of stuff. Understanding the skills you actually need to be able to give advice. It's not just about having the qualification. That's just a slither of it.
Yeah, right. So the question I was then leading to, and I'm actually going to fire this at David, do you think we're going to see any sort of consolidation over the next few years? There was always a fear that entity-based licensing would be the death of the sole advisor business, and although the ministry has been very clear that they want the sole advisor practice to continue, and we've got Class 1 licenses to enable that. We've got some advisors that are starting to get an understanding of what it means to run a licensed business, and we've got others that are kind of just listening to the people above them saying, we can do the compliance stuff for you. So do you think this is going to lead to some sort of consolidation, or are we going to continue to see a spread? How's the structure going to change?
Yeah, so in every industry, not just ours, there is consolidation when you have a regulatory change and also a consumer demand change and a technology-driven change as well. So we're not unusual from that sort of perspective. So we are already starting to see a degree of consolidation, but it's not necessarily the traditional consolidation where you merge one business with another or you buy the book of someone else. In other words, like a roll-up type of thing. There is some of those happening, and we're busy valuing those sorts of businesses and helping them on the compliance side. But the area that we're seeing a big evolution is around the shared service model. That's where you get a grouping of advisors with common interests and common types of clients, and they decide that rather than sort of corporatize, they will share some services, be it compliance, technology, investment platforms, like solutions like what Ben's got, and so on and so forth. And so that becomes a model where they can get economies of scale to a certain degree. They can pick and choose what services they want to use. They can be a varying sized businesses, but they still own their own client bases and they still run their own business. Now, some of those are linked together through technology solutions. Some choose to use brands, and the moment you share a brand, you've got more compliance costs. But this is a very common evolution of sort of single shingle advisors. And there's a huge amount of that happening at the moment. And then that sort of then leads through to this whole innovation that's occurring. And what we're starting to see is a big advent of client portals where clients upload all their information into that and the advisor sort of shares through that. And that way then you're cutting out all of the emailing going backwards and forwards. It's secure, it's easy to use, and it's safe. We're seeing a lot more of client apps coming into the market where advisors and clients can collaboratively work on those things. There's advice avatars like we see in the US that's occurring, and we're starting to see a move from pure product selling through to selling advice, same as what Hannah was sort of talking about. And certainly one of the other evolutions will be through to full service suite of products and solutions. So by full service, I mean the individual advisors may individually remain as an investment specialist or a mortgage specialist or a life, disability and health specialist, But by being co-located and using a shared service model, it's a bit like you and I going into a medical practice. We go to see our GP, who then has access to all of these other specialists. And that's how you can sort of help provide a better level of service to your clients without necessarily losing control of your business. So we see that as one of the other major structural changes that are starting to occur.
I particularly agree with that point that you raised about having I think that there's a really good role for a business that offers across its business, across its brand, a full suite of financial advice products so that the consumer can go into a single brand and have their plan sorted out and all of their different products required in that brand, which, Hannah, you've been doing for a number of years. I just want to open that question up around innovations. What other innovations is everyone seeing in this market for financial advice? And, we're moving to a model, I'm going to come back to this question for Hannah shortly, but where service is expected. And some of these advisors have very large books of clients. And if they're going to service them only as individuals going to see people, they just can't do it in 365 days a year. So they're going to need to have some technological innovation. So what other technological innovations in areas of financial advice businesses are people seeing?
Well, I would say that New Zealand has a long way to go to catch up on the fintech world. And that comes across from an American perspective, that comes across arrogantly. I don't want that to happen. Other markets have a lot more fee-paying consumers that you can spread costs around, and that rationalizes the cost of producing fintech. From Consilient's perspective, what we've had to do is try to partner ourselves with people that have outreach in international markets. And so we can access that fintech at kind of marginal costs in New Zealand for costs that we could never develop ourselves internally. But the reality is that, I'll give it a simple example. If I just want to project, is a client likely to run out of money or not, right? Given a set of plans, there should be lots and lots of easily accessible options available to accurately determine that. I've carefully considered fees. I've carefully considered taxes. I've carefully considered expected returns. I could have disagreements on those, but I'm allowed to view my views in the software I'm using. And so I can show a client, this set of choices leads to an outcome that you're happy with, or if not, we're going to modify that. Even things like that have been very difficult and slow to come to New Zealand. And the thing is, when technology is expensive, that does lead to consolidation, because some of these tools are tools that you need in order to provide the kind of competent investor specific advice that you would feel comfortable with. But that technology is coming. Absolutely. And if it's not coming for any other reason, it's coming because firms like ours are going to make it come, because we need it, because the best advisors in the world have this, and we should have it too. And when that is accessible and inexpensive, that will encourage young, talented, entrepreneurial people to say, I can leave the institution because I want to provide the kind of advice that I feel proud of. And now I have the tools available to me at a cost I can afford. I can get compliance services at a cost I don't have to be an expert in those things. I just have to know where to access those services and buy them and utilize them. I can use a platform technology, and that technology, we have a unique insight on that. That technology is absolutely going to flower over the next decade relative to what it's been in the past. Don't look at the past decade for change in technology platform and how that's going to affect your business. It's going to be far more robust and meaningful in the future than it is now. And so we're highly encouraged by this. And just to touch on the issue of consolidation, listen, as David said, I totally agree. I really appreciate so many of the comments people have made, and David and Hannah and Katrina. But David said, any time you have a change of laws, consolidation is an outcome. right? And we're seeing that. We're seeing, and I think the data you showed that was unrefutable, Mark. You showed consolidation. So that's just a reality. But there's an outcome of that. And the outcome is that the person taking the risk is removed from the person giving the advice. Now, if you have an independent advisor, that person owns the business, they own the risk, they understand the risk they're taking, they give that individual specific bespoke advice because that's what that person needs, and they are comfortable with owning that. However, when you have a very consolidated structure, the person who takes the risk could be sitting in another city, in another office, very remotely from the individual who's actually face-to-face the client giving the advice. The inevitable result of that will always be that the person taking the risk says, I am only comfortable you giving advice in this narrow band, because that way I'm not going to get in trouble, and I can feel like I can control the risk I'm taking. And the inevitable outcome of that will be talented people saying that narrow band doesn't allow me to exercise my full understanding of the client's needs and my full advocacy of what they want, right? And that will be the tension. And so as long as we have competent services you can acquire, technology that's available at lower and lower prices, there'll be entrepreneurial advisors who say, I need to leave the institution because I am not comfortable with this narrow band. I want to give a fully customized, robust advice to my clients. And that's not going to change. It will go this way and that way. As David has said, there'll be some consolidation, but as soon as there's the tools available, people will say, no, I want to give the kind of advice I'm proud of, and I'm going to leave to do it. And I think that is exactly the tension we want, because that will give Kiwis more options to find the service and the cost point they're comfortable with.
You're suggesting it, and I'm excited by this, that technology, together with what David said before about the cost of compliance not being as high as many people have been fearing, that will enable a proliferation of these small, exciting, nimble, targeted businesses rather than just pure domination by large firms, which is it's a really exciting future. But Hannah, can I just ask for your comments around what technological innovations you're seeing that are helping you make your business a bit more efficient and effective?
Yeah, we use a lot of tech in our business, and I'm not threatened by tech. I think, as Ben said, I think tech does the heavy lifting on things that as financial advisors we shouldn't need to think about. And I think that the systems are starting to catch up with some of the things we want to do. So when I first came into this industry maybe 15 years ago, I kind of had all these ideas that I wanted to do, but the systems just weren't there. The tech wasn't there to be able to do it effectively and efficiently. And what we're seeing now is some of these things that are coming on board, whether it's access to platforms or whether it's access to data, I just think it's incredible. But it forces you, because that you now can't rely on. Well, I think Ben said it earlier on, when some organisations previously in the States, they could hide behind their data and their systems because they had so much oomph. They were too big to fail. Whereas now, one-man bands can get access to some of this data and the systems, and it allows them to be on an even playing field and for them to specialise in the things that they actually want to do, which is, I just want to provide financial advice. I don't want to have to build platforms and try and create a system because I can't access it. I'm happy to pay a SaaS model to access different parts of different types of technology. I think it's fantastic, and I think it's going to revolutionise this industry. And I'm all for the tech. I think fintech is awesome. I think some of the fintech products that are coming out of America and Europe and the UK, incredible. And it's going to help consumers, but ultimately I think it's going to help financial advisors specialise in the thing they do best, which is, I'm going to provide advice.
Thank you, Hannah. I'm sad that we're running out of time because there's just still so much more we could discuss, but I have to go through to our final question. Trina's here from Chatswood Consulting. who are sponsoring this particular panel. So one final question for everybody. The Financial Advisors Act review aims to achieve better access to financial advice that improves customer situations and without undue compliance costs or barriers. How do you reflect on the objectives briefly, particularly regarding the future of financial advice and the opportunity that this is going to bring to consumers? How's this all going to settle and bring better customer outcomes? Katrina, can I start with you on that question?
Yeah, sure. I just want to quote 2 bits of research that we did last year on the trust and advice. 93.7% of clients rate their advisor as good or very good with regard to trustworthiness. 72.2% of people who haven't used an advisor agree financial advisors are trustworthy. I think what this legislation does is it builds public confidence and trust, and it does that through the raising of standards, consistent standards in the sector. It does that through professionalising financial advisors and professionalising financial advice businesses. And I think that will allow more accessibility of financial advisors, and that'll increase New Zealanders' financial wealth and well-being. So based on that, I think the outcomes of this new legislation will be successful.
Well, thank you, Katrina. David,
look, I concur in that. And if someone's doubtful, what they need to do is go back and look at the purposes of FMCA, which is what you just mentioned there, Mark, and then people will be sort of gobsmacked, because many people think the purpose of this act is to make things more cumbersome and to make things more complex and to make things more expensive and more client sign-offs. It's actually the reverse. This will simplify things, but people have got to get their head around this is the future that this legislation is addressing, not the past. And so if people actually understand the legislation and upskill to understand the wriggle room they have in it, they will be able to roll out better quality advice at a faster pace, probably cheaper and a lot simpler than what they've done before. Now, advisors will think, gee, I'm going to make less money. But the reality is they will be able to make more money because they'll be able to charge realistic fees and they'll be able to service more clients. So I think it's all positive for the consumer and it's positive for the advisors. What they need to do as an advisor is just change their mindset and embrace this, and they'll be able to do fantastically moving forward.
Thank you, David. Hannah.
Yeah, well, I think you can't argue with the stats that Katrina is quoting, right? That those who do use an advisor, for the most part, are better off for it. I think the legislation is only going to do good things. It's only going to bring in rigour. It's only going to increase the standard. It's a change, though, and change can be painful. I get that. But I think it's going to be good. I think what would be really great as an industry if we could also be tracking not just how effective or trustworthy our advisors are, but are we increasing the people who are using financial advisors? Because not enough people are using them. It'd be great to get a metric on that. And can we also get a metric of, can we get a career pathway for young people to come in and to actually start to shake up this industry? Because although there is a tension between having the wisdom of experience that is needed as opposed to just a qualification, which again Katrina alluded to earlier, it would be great that we're going toe to toe with the accounting and the law industry in recruiting the best recruits out of university and at different life stages. I think that would be great, and it would be great to go from I think what David said earlier, where sometimes in referencing Australia it was almost like a second career for people. It's like, well, I've finished this career, what can I do? I can sell real estate or I can be a financial advisor. That's kind of what's going through their mind. It would be great if people choose to be a financial advisor, because this is the place you want to be adding value to people's lives. That's where we want to get to.
Well, thank you, Hannah. Ben.
Thanks, Mark. And I'm not to be a contrarian at all. I just think that great advisors will clear whatever compliance hurdle you put in front of them. And that's what I'm saying. I'm saying every great advisor, and I work with lots of them, saying the bar's here, fine. The bar's here, fine, because I'm dedicated to giving great advice, and I will do whatever you need me to do. Disclose, fine. Educate, fine. The great advisors have no problem with education. Do you know why? They're constantly educating themselves. They're constantly getting better at what they do. They're constantly going back and doing and doing and getting more and more knowledge so they can do their jobs better. I talked to one advisor. He says, I do hundreds and hundreds of hours a year at getting better at my craft, right? And that's what the great advisors do. And so this legislation is not going to make great advisors, and it's not going to stop great advisors. What it's going to do is provide, hopefully, a stable forum so we actually know what to expect, so that we can go on and get into the jobs of giving that great advice. And it will cause some consolidation, perhaps in the short term, but I think in the long term, with or without this legislation, I think we're going to see better and more quality advice from better and higher qualified advisors into the future. And I actually think, to echo everyone else, I think the future is going to be way better than the past. And I haven't really talked to many people that think differently, that have thought about this carefully.
Thank you, Ben. Thank you, Katrina. Thank you, Hannah. Thank you, David. Thank you, Ben. I can't go any longer because I've already taken too much time. We've got to say a big thank you to Chatswood Consulting, who have sponsored this. You should know, if you don't already, that Chatswood is a stalwart of this industry with incredible industry knowledge, particularly around the insurance space. So without further ado, Trina, all yours.
Thanks, Mark. I'm Trina Jordan, General Manager of Quote Monster, and as Mark said, Chatswood Consulting and Quote Monster are pleased to sponsor today's professional advice session. Like today's panel of speakers, Chatswood and Quote Monster are committed in helping advisors through the coming years. I'd like to express our thanks to our astute panel of speakers today, Katrina, Ben, Hannah and David, thank you. And thank you to the FSC for organising such a great event. And thank you, Mark, for facilitating today's session.
It's been a pleasure, everyone. I'd love to be able to continue this for another couple of hours. It's days. Have a great weekend, everybody. Thank you so much, Chatswood, and thank you to the FSC. Thanks, everybody. Good day.